Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and today we are going to be analyzing International Paper stock, which came in by request down in the comment section. If you have a request you would like me to take a look at, just drop it in the comment section. If it's a stock that's in the S&P 500, I post those for free here on YouTube. And if it's not in the S&P 500, I post those over on Patreon, which is $5 a month. And if you join there, then you get a big discount to my full investing service, the Cyclical Investors Club, over on Seeking Alpha. And those links will be down in the description. As always, this is not individual investing advice. This is just how I analyze stocks. So I'm just going to share with you exactly kind of what I think about International Paper and how I would go about potentially buying it. I don't own this stock right now. I do track it, however, probably because it's part of the S&P 500, but I do have a buy price on it too. So I think it's kind of a little bit of a tricky cyclical stock to look at, but there is I would take a shot at it under certain conditions, probably if I got the right price. I can see why someone would ask about this one. I actually hadn't been following it super closely, even though I track it. It's down about, I think about 50% now. Yeah, 45 to 50, because that's not a perfect peak. So yeah, you would definitely think, okay, maybe this is one that can come back and maybe potentially get a pretty good return. So I can see why it was asked. I've never written on, I didn't double check this, but I don't think I've ever written on International Paper before, even though I've just kind of looked at it privately. So the first thing we want to do, I already mentioned that this was going to be a deep cyclical stock, and it is, but let's look at it just with fresh eyes here. Shortening this so we can see the drawdowns more clearly. So if we go back to the Great Recession, what I'm looking at here are earnings drawdowns, or earnings growth declines, however you want to kind of think about it, where you have a peak earnings period like in 2007, and then if it's lower at some point in the future, that would be considered like an earnings down cycle, right? And that's what I use typically to kind of categorize cyclical stocks. International Paper has been around a very long time. I mean, I'm sure they've had like M&A and stuff along the way, but there's enough data you can go back and get an idea about how cyclical they are. And when these 2 years are combined together, that's more than 50%. It's probably more like 60% to 65% earnings drawdown. That's the dark green area here. Not necessarily the price, which we'll look at next. First, we want to establish whether the business is cyclical. Then we get over to 2020. Now, this is a little bit of I would call this a little bit of anomaly in a couple ways. One, my guess is that since this is a US-based company, this 2018 earnings growth of 50% largely probably came from tax cuts, like one-time tax cuts. The tax cuts are still in place, but the growth they would have gotten from that year going forward would just be for that 1 year. So you wouldn't expect them to be able to keep growing like 50% or whatever. So that kind of gave them a higher earnings peak than they probably normally would have. And then obviously with COVID, they probably had maybe more of a decline since then. So I think if you just want, but if you do put these together, that is another deep earnings down cycle, even though it's, I wouldn't base an entire investment around that. One thing to maybe look at that and we'll keep this normal one down cycle in here to begin with. If you look at like 2011, after they fully recovered, actually they almost fully recovered by the end of 2010 to their previous earnings highs. If we just look from there up until that tax cut year, like from 2011 through there, this is what they're doing like mid-cycle, right? So this is only about 8% earnings growth. That doesn't include this down. It probably doesn't include this down year either, or this one. So we're probably looking at like 6 to 7%, maybe 7. We'll call it 7% earnings growth mid-cycle, like when they're not in a big up cycle or down cycle. Although this is like a 51% gainer here, so if we took that out, we'd probably. Then you got to be careful with your sample. So you're looking at kind of flat earnings. I looked at the dividend growth recently, which can sometimes help you because they lowered the dividend back here, but since like 20 maybe about that same time period, like 2012, they have been kind of raising the dividend. And I think when I checked it, going back to like 2015, the dividend's been going up about like 4% or something a year. So I would say, really, you're probably looking at that, probably is pretty close to like their underlying earnings growth under everything, 4 to 5%, we'll call it. Which I would say is slow but still adequate. It's not so bad that as a kind of a all-weather growth investor that I am, it would be borderline but okay to invest in, which is why I actually do have a buy price on it. If you can get everything kind of aligned just right, and I'll get into that. So this is a deep cyclical stock. So because it's deep cyclical, you want to avoid looking at like a PE ratio, because it's not going to tell you very much about how over or undervalued the stock is. For example, right here before the stock, this isn't at the peak. This is just, that's a 15 PE. That's like a pretty average PE, maybe a little high for them. If they only averaged like 4, 5, 6% earnings growth, but it's not like crazy. That's like long-term market average. So it fell all the way down 85%, even if you bought it at a 15 PE. That wasn't the peak, like up here. So, or even here, it could have had a 10 PE and looked attractive, but because these earnings fell, if you bought it with a 10 PE, you still would have lost 80%. So this is why you don't want to look at the PEs, or at least they aren't very useful at predicting future returns with deep cyclical stocks usually. So because of that, I use historical price cycles along with a lot of other kind of checks and measures to make sure things are still similar as they were during the last cycle or two, to help guide me, to give me an idea. One, we looked at how far earnings can fall, but often the market will react to that differently from stock to stock and industry to industry. Well, in these guys' case, they lost, I have it down in my spreadsheet as 95%. I'm not sure exactly what hold on a second. The fast graph won't have it show up perfectly, but from say here down to the trough is 90, and I have it down as 95. That might have been from the peak up here, but very deep drawdown during the Great Recession. So that's one thing to note. Earnings are capable of falling, call it 60% in a recession, and the price is capable of falling 95% in a recession. And then these mid-cycle price cycles, which are pretty interesting, they're relatively consistent here, and they generally are about 50. I think this one might be slightly shy of 50%. So this one's more like 40 or 45. This one, which even though it was a little bit unusual, was more than 50. And then the one we're in now is about 50. So I kind of think of this as like a recession is the deep cycle. These mid-cycle ones are just kind of when we don't necessarily have a big recession. We did have a very brief recession here in 2020, but it was very unusual. So you can say like, okay, you definitely wouldn't want to buy this stock ever, pretty much, from my point of view, unless it was at least 50% off its highs. And if you think that we could be in late cycle conditions with the economy or with the business, then you really want, well, I'll tell you what, mine is 75. Like I want it to be 75% off its highs before I would consider buying it. Because usually I don't want to suffer more than a 50% drawdown even while I'm waiting. But I do want to give myself a chance to actually buy it without having to like perfectly pick the bottom. So now if you bought this back here, this is worth pointing out because I'm going to have a deep buy price. But let's say let's see if I can look. Let's shorten this real quick. And let's look at the last. I do think we're in late cycle conditions with the Fed raising interest rates. Interest rates are high. How bad a recession will be, whether it'll just be a slowdown, all that stuff I don't know. But I do know that it feels much more like late cycle conditions than it does like early cycle conditions. So I'm on the cautious side, and I'm aiming for like a 75% drawdown before I would consider buying it. Part of that's also because the underlying business doesn't have a lot of growth. I mean, it's just adequate enough. So there are definitely things that can go wrong, or it could just take a long time to recover. I didn't look at like their debt or anything. They have a decent amount of debt, which they probably always had. I haven't gone back and checked it, but I doubt it's too much different than historically. But what I wanted to show here is if you bought after, this might be a 50% decline. That's almost a 50% if I went from the peak back here. So again, if you bought here on this first dip, you still would have had an 80% drawdown. But the good news is if you went out 5 years, let's see, when is that? So 2013, mid 2012, 2013, let's see, 9, 10, 11, 12, 13. If you went out 5 years, this is kind of what I roughly use. I want to usually recover by that amount of time on a deep cyclical. So you got to double. So it still would have met the my basic kind of requirements. It would have kind of just been right on the edge of meeting those. You would have had to wait 5 years to get a double, but that is a nearly, high teens. There was a little more than 100%, but you'll get between 15 and 20% if a stock can do that. But you would have had to hold through an 80% drawdown in the process. So you need to understand that that's definitely possible. And as a matter of fact, that might just be the key lesson here is to, if you do buy a stock like this, your thesis might not be wrong if you're down 80%. You could have bought after the 50% drawdown, drew down 80%, still made nearly a 20% CAGR and 18% CAGR after 5 years through a bad recession. So that's possible, but I like to kind of minimize that as much as I can. Now, if these guys were a faster growing business, maybe like like AMD is kind of similar now to some degree, or some other semiconductor stocks. When I know that there's an underlying growth that's still happening, I'm willing to come in like sooner, even if they've experienced like 80%, 85% drawdowns. I'm willing to come and buy those a little bit sooner than I would be with something like this. So, and even buying at a 75% drawdown, which I'll show here in just a second, even if you buy there, that if it does fall 95%, that's still more than a 50% drawdown. So you would still have to sit through it. But I feel more comfortable there. And then also one thing to think about is your returns will be that much better if you wait for it to recover. Usually I think about deep cyclicals. Once they recover their old highs, that's around the time I typically sell them unless something else is going on. So I don't know. If you bought here and you held through that same time period, what was it, 2013, mid 2013? So you would have had a 33% CAGR and a 250% return. So, and usually if you think you can just do, I don't know if that was at the 75% mark, but if a 75%, if you buy a stock when it's $25 and it goes to 100, that's what 1, 2, 3 doubles. That's a 300% return. So if you do wait for that extra margin of safety, not only do you have more margin of safety, you have kind of less pain, but you get triple the returns that you would have had if you bought at the 50%. And not everybody has to buy in chunks, kind of like I do. I usually take like 1% weighted positions. On a stock like this, you could take a 1% now and wait. If a deeper drawdown comes, take another one. You could start here if you wanted to, and then just slowly average down. If it fell, that's perfectly fine. I don't usually do that because it's hard for me to track the results for everybody. I try to track all my results so people can actually see my returns and everything. And that gets difficult if I'm making like a bunch of different tiny purchases and things like that. So it would be as long as a person knows what they're getting into, it's kind of at the point now where that would kind of be okay to start nibbling. I'll be waiting for that 75% drawdown, which I will pull up here, maybe, which I have at $15.45 a share. So that would be my buy price, just a little more than 50% lower. They haven't really had any, let's see if I shorten this. They haven't really sold down that cheap recently. Maybe. Actually, my face is in the way, I can't see. Yeah, we didn't get down there in 2020. A little bit close, at under $25 a share. So, but that wasn't a very big down cycle, and it didn't really have a true recession. So Earnings are expected to be lower next year. I don't see a lot of risk of this taking off, but it could if the economy picks up. Probably wouldn't happen in this next like 6 months, but it could after that. So those are my thoughts on international paper. Hopefully that helped investors kind of know the risks, rewards, and kind of how I think about it. And best of luck. Click the subscribe button if you found this useful. If you have a stock you want me to take a look at, put it in the comments section, and I will get it on the whiteboard behind me, and I'll eventually make a video. Thanks.